Am I audible? Anyone can give response?
Yes, sir, you can.
Yes, sure.
Okay. Thank you. Yet students are joining. Okay, let's start. Unit number 3, risk management in banking. Market risk, environmental risk, currency risk, legal and regulatory risk, rating risk. Already we have discussed about market risk in previous sessions. But again, I would like to discuss in few minutes market risk, meaning market risk is the risk of losses arising from adverse movements in market prices such as interest rates, equity prices, commodity prices, foreign exchange rates, types, interest rate risk, equity price risk, commodity price risk, and currency risk. Measurement tools, value at risk VR, stress testing and scenario analysis, sensitivity analysis, duration gap analysis, measurement techniques, setting trading limits, diversification of portfolio, hedging using derivatives, daily market to market valuations, risk monitoring through ELCO. Now, today we will discuss about environmental risk. Meaning, environmental risk refers to potential losses arising from environmental issues such as climate change impacts, pollution liabilities, natural disasters, non compliance with environmental laws, sources, financing environmentally risk projected, regulatory penalties, physical risk, flood. These are national calamities, physical risk. In this session, we will discuss a variety of analytical tools that may be adopted for risk management purposes. Initially, common tools applicable to analyze trends and emerging issues within predictable and known business environments are put forward, and a resemblance to strategic management is revealed through examples. Uncertainty is added to the spectrum, and the use of templates such as scenario and real options is outlined. It is shown how these approaches may enable the corporation to evaluate the effect of a changing risk landscape and to take necessary precautionary measures. Environmental uncertainty affects the corporation and introduces unexpected events that can cause major derivations to plans. The relevance of contingency planning is discussed, and it is argued that it may work in simple and predictable environments to handle more severe deviations. However, It is subsequently argued that it must be complemented by a culture of mindfulness known from high reliability organizations in more complex and unpredictable environments. The session is rounded off with a discussions of risk management under unknowable environmental conditions as it must deal with angst, the role of values, behavior and corporate culture in dealing with uncertainty and unforeseeable events is considered. Angst means uncertainty and unforeseeable. Environmental scanning in a predictable world. Corporations often face environmental changes that seem to come out of thin air. The previous session suggested that nearly 90% of the drop in shareholder value can be attributed to strategic and operational risk events. This accentuates the questions of how the corporation can better identify and foresee events that often appear initially as weak signals at the corporate periphery where the actual transactions take places. Hence, the ability to involve the relevant people in the organization to be observant and sensitive to change in the risk environment may enable the recognition of important environmental changes sooner and allow the firm to react to them in a more timely manner. Admittedly, it is difficult, if not impossible, to tell the future, and these weak signals are often difficult to see and not least to interpret. For example, Taleb 2007 points out the general failure of forecasters to predict the abrupt and often drastic changes that occur from time to time. For example, the emergence of major technologies, including the computer, the PC, the internet, and the laser, were unplanned, unpredictable, and unappreciated upon their discovery and well after their initial use. We are lucky that our satellite systems today become very strong because we can check the future environments where dot system will be found, where flood system will be occur, and where cyclone will be come. These environmental issues can be resolved with the help of the strong satellite which Indian scientists developed for our India. Means all the people from that area already informed about the future dangers and they have to leave that area to sustain. Similarly, few people, if any, expected the US subprime mortgage market meltdown over the course of 2007 and the subsequent consequences for the international financial system, despite the early emergence of weak economic signals. The macroeconomic context in the preceding period was characterized by excess global liquidity, historically low interest rates, increasing current account deficits in leading economies, and not test abnormal increases in real estate prices. These trends could have been monitored and evaluated to foresee the buildup of a house bubble and raise relevant. What if question about the potential economic consequences if the bottom should drop out of the housing markets before 1 decade or 2 decades, the rate of houses in Pune city were too very low. You will get a flat within 10 to 20 lakh. Now the cost is above 70 lakhs or near about 1 CR. That is only 2 BHK. If you want 3 BHK or more, you have to pay more than a crore. Hence, we claim that preparing for responses on emerging risk events can increase the efficiency in dealing with uncertainty. Thus, the corporation should have a structure in a place to identify and evaluate key trends, emerging issues, and events. Environmental scanning can be considered as incorporating four modes of viewing the environment and searching for important environmental developments. Formal search, where the corporation in a structured way obtain information of relevance to specific issues as input to the planning process and decision making. Conditional viewing, where the corporation track pre-selected information from particular sources aimed at identifying the contours of specific evolving issues. Informal search, where the corporation actively looks for information through unforced and unstructured efforts to increase understanding of specific developments, to assess potential impact and the need for responsive actions. And the last, undirected viewing, where the corporation scans many diverse sources of information without specific information needs in mind to sense new trends and enable the corporation to think about environmental developments in unconventional viewing, informal search, undirected viewing, and formal search. General environmental risk, industry risk, and company risk. The corporation must choose the right balance between those four models of scanning. Too much focus on undirected viewing might result in huge cost, information overload, and not least a lack of focus. On the other hand, unilateral use of conditional viewing and formal search, although cost efficient, might result in a too narrow scanning of the environment and might cause the corporation to miss out on fundamental changes. Generally, the more complex and volatile the business environment is, the greater the needs for undirected viewing. Formal search and conditional viewing applies more to central planning activities with the aim of integrating and coordinating existing corporate activities for economic efficiencies. Informal search and undirected viewing refers mostly to the observance of people at decentralized functional entities in the organizational periphery, closer to where operational, supplier, and customer transactions are carried out. Hence, the ability to process information, to optimize current activities, as well as scanning the periphery for new emerging market trends suggest a dual emphasis on central planning and decentralized observance. There is no standardized way to scan the environment and analyze the broad amalgam of possible risk factors. However, one way to approach systematically the analysis of a wider risk spectrum is first to consider the general environmental conditions that circumcise the entire community, then to consider business conditions specific to the industrial environment in which the corporation operates, and then finally to focus on the factors that are internal to the company's own operations. General environmental risk. General environmental risk comprise number of exogenous factors completely outside the control of corporate management that circumscribe the general business environment, affecting all actors across industries and sectors, albeit in different ways. These types of risks are often categorized to consider particularly factors such as political events, economic development, social trends, technological innovations, and the like, which may be analyzed within the so-called PASTE and PASTEL framework. Drivers of change in non-life insurance, for example of how this type of analysis may be used. Drivers of change in non-life insurance, political issues. PEST means political issues, economic issues, social issues, and technological issues. First, political issues. The personal non-life insurance industry is faced with increased political pressure to introduce more transparent products and pricing schemes that allow the consumer to compare different market offers. Furthermore, the adoption of new regulations on capital requirements, the Solvency II rules, will affect the insurance industry by imposing higher capital requirements. Second, economic issues. An increasing trend in the demand and supply of welfare benefits will generally impose a higher proportion of consumption being spent on services. Third, social issues. The insurance industry is faced with a trend towards higher demands from younger employees for personal growth and job satisfaction. It is common that both spouses are working, which imposes higher pressure for balance between the time spent with family on the job and the general spare time. In big cities, both spouses are always on job because the dearness ratio is increasing day by day, and it is really high to maintain all the regular expenses that are our children's educations, our apparels, jewelries, our dreams, to fulfill our dreams, like to get a car, to buy jewelry, to buy a home, dream home or a flat. And we have to also invest in our future, that's our FDs, insurance. mutual funds, shares, and investment in open spaces, land. Fourth is technology issues. The increased use of the internet to compare prices between competing insurance companies on similar products, either though broker or directly on price and product sites will affect the competitive dynamic. The improvements in streaming video and availability of low cost bandwidth will make it easier to speak directly to customer through their computers. The internet has also changed the way in which companies is in other industries communicate and trade with the customer. Before one decade, the speed of internet was up to 2 Mbps, and now more than 50 Mbps speed is available. This is because of new technology and R&D in the field of telecommunication and information sector. Environmental issues. Terror is becoming an important environmental concern, particularly after 11 September. What's happened? What did you do you know about World Trade accident and has put severe strains on the prices for property reinsurance. Furthermore, climatic changes can affect weather conditions and impose higher disaster losses and subsequently higher reinsurance rates. Legal issues. The potential removal of the access to door selling can have a major effect on the current sales practices. The existing legislation make it possible for insurance agents to contact customers directly, for example, by phone without prior consent. Hence, an important distribution channel will disappear if this is made unlawful. Nowadays, there are so many marketing calls on our mobiles in which we are always trying to reject their communications because of few fraudulent calls also coming from the spammers. Industry risk. Industry risk refers to factors defined at the industry level where competitive conditions may influence corporate exposure, while corporate actions may affect industry developments. Some typical frameworks adopted at this analytical level include, for example, Porter's five forces model, Porter National Diamond Model, industry network structure, the value migration between different industry segment, competitive analysis, making of strategic groups, market segmentation, etc. Conventional industry analysis consider conditions that are specific to the particular business environment, including new product development, process innovations, changing customer needs, industry regulations, etc. Competitor analysis is often adopted to determine the strategies of existing and potential competitors, possible strategic moves, and their expected consequences. Our college has arranged an industrial visit in Parleji company, and this Parleji brand is really very old product. Okay, and the taste is same as before 30 to 50 years. Okay, and the child's photo on that Parleji brand, the child is not child in reality. It's a grandmother of Nagpur city. Okay. But the photo of that a child is famous to identify the product Parle-G. There are another products also available which compete the Parle-G product, just like Patanjali, Britannia, Crackjack, Monaco, and Little Hearts and others. Okay, but the taste of Parle-G on the mouth of everybody is fixed. So everyone must like Parle-G, which is available on low rate price, that is from 5 rupees to 10 rupees. And later on, they have changed new products, cream biscuits, orange, chocolate, pineapple, and other flavors because of new development and new demands of the consumer of new era generation. So I request you all that you all should have to attend that industrial visit. It is mandate to all, and you have to submit your undertaking, your own students undertaking and your parents undertaking. Just sign it and send us photo on today only. Okay, and submit the physical copy on tomorrow. Industry threats and opportunities in non-life insurance. An analysis of the profit dynamic in the industry can use Porter's five forces model. The model makes assignments about the industry's attractiveness based on the effect of five key forces, namely the threat of new entrants, second, the bargaining power of buyers, third, the bargaining power of supplier, fourth, the threat of substitute products or services, and fifth, the intensity of competition in the industry. Each of these points is examined below. First, insurance is a complex business and requires specific skills and experience. Customers are often conservative and retain all of their policies with one of the major insurance companies. So, it is difficult for niche players to enter the market. Furthermore, it takes substantial marketing cost to establish a market presence as the industry sells standardized products to a mass market. Consequently, the threat of new entrants is low. Second, the non-life insurance products are in demand because they provide the customers with safety and peace of mind. The cost of switching from one insurer to another is relatively high and is a rather time consuming process. However, a market survey shows that customers see no significant differences between the major market players. So, new customer could possibly be attracted by better price quotes. We know about our SIM cards. If we don't like the services of our SIM card provider, we immediately take decision to switch. Okay, and government also given permissions to switch your insurance policies if you are not satisfied with the services of insurance company. Insurance sector is related to service sector. The survey further indicates that nearly one third of the customers are disloyal to their current insurance provider. That is, the bargaining positions of the buyer is generally low. but a certain position of the customers may be accessible through differentiated product offers and competition on price quotes. Third, the higher reinsurance premiums affect the cost in the industry, and less consolidated insurance companies will have to retain a larger proportion of their risk because they cannot afford the higher cost of obtaining reinsurance coverage. Consequently, these companies become more vulnerable, and large industry incumbent are in a better position. Four, there are few direct alternatives to non-life insurance policies besides self-insurance through personal savings. However, this will not provide full coverage until the full amount of the potential loss has been saved. Five, the nature of the businesses is relatively stable with changes in products, productions, technologies, and customer behavioral changing infrequently. The market is dominated by the major players, which account for around 65% of the market, and they do not differ significantly from each other in terms of market offering. This leads to intense price competition to maintain or gain market share. That is, the rivalry among the major market players is very high. The character of the market is changing somewhat due to increased distributions, partnerships with major banks, whereby some market activities co-evolve, possibly to develop new market opportunities. Hence, an increasing share of the non-life insurance sale is taking place through the banks that have closer relationship to their customers through widespread branch network. And extended analysis shows significant differences in the distribution channels available to the insurance companies, as some use the banks as a major distribution channel, while others use insurance agents, where the latter may be vulnerable to prohibitions of door-to-door selling. You know that in insurance sector, most of the bank taken jumps, just like SBI, SBI life insurance and general insurance, HDFC, ICICI Prudential, and other banks also jumped in this sector because it has a large potential businesses. And keep in the mind that our entire family must be insured to avoid future risk and to sustain our life. So take all life insurance as well as general insurance, just like mediclaim. Company risk. Company risk related to risk factors that are endogenous to the corporations, as they are caused by organizational processes, technological systems, and actions taken by members of the organizations. The type of company risk to considered may typically include things like operational disruption, technological breakdown, misreporting, legal mistakes, fraudulent behavior, inability to observe and react to market changes, etc. Some of the common frameworks and tools that can be used in the analysis of the company's internal environment include the McKinsey 7S model, value chain analysis, the VRIO framework to assess the sustainability of essential corporate resources, analysis of core competencies, etc. Assessing company risk, for an example, as to how the frameworks can be selectively applied to analyze the company's internal risk environment. Assessing company risk. Many of the operational activities in the value chain are dispersed to the local market entities, whereas centralization of certain common activities, for example, claims handling, could be located at a central function more efficiently without adversely affecting the service provided by the sales staff in the field. This is so due to a strong core operational processing system that ensures an efficient underwriting and claims handling. Furthermore, the potential to launch effective e-insurance systems is strong. The firm has strong competencies in risk management, underwriting claims, assessment, and compensation handling. This is reflected in favorable claims ratio and customer portfolio compared to competitors. However, a lack of competencies in customer relationship building and servicing is a weakness in view of the opportunity described in below. Industry threats and opportunities is non-life insurance, means general insurance. The company has a strong set of shared values to guide the employee behaviors towards customers and colleagues. These values are supported by more than 90% of the staff, according to the recent staff survey. The strong architecture between risk management, price calculations, inbound logistics, underwriting, claims assessment, and compensation handling is a definite strength. However, the company's unified distribution is possible, a weakness due to the potential removal of door-to-door selling. The company's financial position is relatively weak due to recent loss of equity capital and a corresponding decrease in the solvency ratio. This will limit the scope for business expansion. Furthermore, the expenses ratio is relatively high compared to main competitors, which is the risk in the industry characterized the system and e-insurance platform are expected to improve the cost ratio and future profitability. Claim passing ratio. All the documents, verify the documents, whether that documents are true, the incidence is occurred really or it's a fake. The above mentioned analytical tools and approaches are typically used to assess the strategic positions of the corporation in terms of development in external market conditions and internal organizational capabilities. That is, these tools often focus on existing perceptions on the macro environment and industry conditions. However, these are alternative analytical approaches that can be adopted to stretch prevailing benefits about the environmental context. The formal strategic uh, management and planning frameworks that incorporate these analytical tools adopt their own terminologies contained within a common strategy language. This corresponds to the recommendation proposed by ERM components and proponents of developing a common risk vocabulary within the corporation to stress an emphasis on the risk management and facilitated internal communication in the risk handling activities. It provides an example of a common risk management language based on four broad categories of strategic hazards, financial and operational risk. The common language can be constructed in many ways. For example, COSO has two broad risk categories and 10 subcategories, while the risk consulting firm Protivity introduced a three broad categories and 18 subcategories. Thus, it should be recognized that such a common language can be tailored to the company's specific circumstances and needs. Typically, a tailored common language is developed through interviews and workshops at various levels of the organizations. These procedures are in many ways analogous to the strategic management activities aimed at developing a common understanding of the strategic situations and communicate an overarching future direction for the company. The main advantages of establishing a common language is that it ensures a more consistent way of looking upon the analyzing risks across the organization. The strategic analysis is typically summarized in a SWOT analytical framework where strengths and weaknesses identified in the internal corporate environment and opportunities and threats identified in the external market environment are compared against each other and prioritized. In this example amplifies a SWOT analytical summary based on the evaluations performed in the previous boxes. As it appears, the summary of the strategic analysis within the SWOT framework can actually help to identify important strategic risk factors. However, the SWOT analysis does not explicitly state the relative importance of the various risk factors. This shortcoming can be circumvented by completing a risk map, which can be considered the SWOT equivalent within the risk management field and is elaborated through a more normal approach to rank the various risk issues. The result from the SWOT analysis can essentially feed into the initial assessment phase of the risk management process. However, as the SWOT framework normally focuses on strategic and economic risk factors, the SWOT analysis might be complemented with assessment of operational risk factors and hazards. When the various risk factors have been identified, the associated exposures should be evaluated with the aim of determining those risks that represent the most material economic effects. The various risk factors are assessed from two perspectives, namely the likelihood that the underlying risk event will occur and the economic impact the specific risk event is expected to impose on the company. The criteria for rating the likelihood are generally based on qualitative assessment and managerial judgments expressed in a ranking of the different events. The ranking efforts may, for example, be illustrated and expressed in a scoring system. Rating criteria and their impact. Rating catastrophic impact threaten the firm's existence. Saver, their description is loss estimated exceeds 2 months of profit before tax but do not return the existence of the firm. Another rating measure estimated losses between 10 days and 2 months of profit before tax. Significant rating estimated losses of 1 to 10 days average profit before tax. Moderate ratings estimated losses of 10 to 100% of the average daily profit before tax. Minor loss estimates below 10% of the average daily profit before tax. The criteria for assessing the economic impact of the identified risk factors also often have to be based on qualitative judgments. These risks typically represent exposures that are harder to quantify, so the rating may express rough indications of the potential direct economic losses caused by the event as well as the expected effect on the company's future earnings potential. Once the two rating scale likelihood of event, expected economic impact of the event have been adopted in a qualitative assessment of all the identified risk factors, they can be plotted into a 2 by 2 framework. The finance assessment of the corporate risk profile is then done on the basis of the resulting risk map. The most important risks that require the urgent attention of corporate management are made up by the gray color events positioned in the northeastern corner of the map representing high likelihood, high impact events. In contrast, the low likelihood, low impact events, black color, in the southwestern corner do not warrant the same managerial attention. Furthermore, some risks may have short-term effects while other may have longer-term potential effects. Thus, the timing aspect should be considered when prioritizing and allocating responsibility to the various exposures. Some important risk factors need immediate and ongoing treatment, mitigation initiatives, process controls, higher frequency monitoring, and are normally dealt with at the tactical and operational level in the organizations. Other important risk factors may have longer term and less immediate potential effects, emergent risk or phantom risk, regular low frequency monitoring, and are generally treated at the tactical and strategic level in the organization. However, the risk timing map shows the assessment of the various risk factors in isolations where potential interdependencies are not taken into account. Yet, the risk analysis can be extended with an impact influence analysis aimed at determining the interdependencies between the various risk factors and thereby pinpointing those risks that might have the greatest potential impact. This result can substantially form the basis for discussions about how risk might be mitigated or exploited effectively. The so-called influence metric is an appropriate tool for such an analysis. The idea behind the influence metric is to evaluate the interactions between the various risk factors on a qualitative basis in the absence of exact relationship. Thus, the insurance matrix is the qualitative counterpart to the qualitative approach applied in value at risk assessment, where it is possible to calculate exact relationship between risk factors based on historical accounts of price developments. The ranking of the various risk factors can be illustrated in the form of an example. First, it evaluated the extent to which each individual risk factor has an impact on each of the other risks using a graduation scale. 0 for no or insignificant impact, 1 for some impact, and 2 for high impact. For example, e-insurance is a key element in establishing a distinct position in the market, and accordingly row 1 column 2 is assigned the weight of 2. Similarly, e insurance will enhance the transparency of prices considerably, and consequently row 1 column 7 is assigned the weight of 2. Conversely, insurance will have no effect on the assets of door-to-door selling, and accordingly row 1 column 9 is assigned the weight of 0. In this way, the assessment is carried on for each risk factors. The across columns total of measure sideways along each row indicates how the risk factors affects all of the other risk factors and accordingly capture the importance of the specific risk factors and its relative ranking. For example, the risk e-insurance receives a total score of 21, which is the highest score, and consequently, this risk is evaluated as the one with the greatest risk impact. I always suggested students that try to become master in Excel. MS Excel means Microsoft Excel, to show the best result or analyze your data with the help of pivot tables, with the help of different types of formulas which will be used for financial calculations. You should have to give daily minimum 2 hours to learn about Excels. You can also see few reels on YouTube or Instagram about Excels and the actual problems faced by the corporates at the time of real life work or real life situation. So you must be master in Excel. So note down in your mind that you have to give minimum 2 hours for Excel if you are belongs to financial field. If you want any different types of formula are not understood by you, you can meet me. I can explain you that formula in very easy steps. Concluding from this analysis, the handling of e-insurance should therefore receive the top priority as an appropriate strategy for handling this risk will affect other issues as well. The across row total of measures top down along each column indicates how much each risk factor is being influenced by all of the other risk factors, the so-called passive score. For example, the risk factor customer living rate together with price competitions receive the highest total score of 20 and accordingly constitute the risk that are most affected by all of the other risks. In contrast, those risks that receive very low passive scores cannot be addressed indirectly by handling other risks due to the absence of interdependency. For example, the risk access to door-to-door selling, core insurance system, risk management skills and knowledge, and solvency receive a passive score of 0, which means that this risk can only be addressed by initiative directed specifically towards them. Management techniques of environmental risk. Environmental risk assessment in credit appraisal, ESG, environmental social governance, screening, climate stress testing, insurance coverage, green finance policies, importance, protects banks, reputations, ensures sustainable banking, reduces long-term financial risk. Currency risk, we already discussed about currency risk, that is foreign exchange risk, FX risk, meaning currency risk is the risk of loss due to fluctuation in exchange rates affecting foreign currency assets and liabilities. Types: transactional risk, translation risk, and economic risk. Measurement tools: net open position limits, value at risk, VR, sensitivity analysis. Management techniques: forward contracts and futures, currency swaps and options, matching foreign currency assets and liabilities, stop loss limits, centralize the law, forex risk monitoring. Legal and regulatory risk we have already seen in previous sessions, meaning legal and regulatory risk is the risk of losses due to violation of laws and regulations, non-compliance, and RBI Basel norms, litigations and penalties, contractual disputes, sources, weak documentations, changing regulatory framework, fraud and mis-selling, data protection and cybersecurity laws. Management techniques: strong compliance framework, regular legal audits, employee trainings, KYC and AML procedures, internal controls and governance. Rating risk, meaning rating risk is the risk of loss due to downgrade of borrowers or issuers credit rating, adverse changes in credit quality, impact, increase in capital requirement, decline in market value securities, higher default probability, loss of investor confidence. Measurement tools: internal credit rating systems, credit migration, transition metrics, credit spread analysis. Measurement techniques: continuous monitoring of ratings, portfolio diversification, early warning systems, exposure limits based on ratings, provisioning and capital buffers. Importance of managing these risks: maintains financial stability, protects bank capital, enhance investors and customer confidence, ensures regulatory compliance, promotes sustainable banking practices. Thank you. Today's session is over.